2016, as we look back, will probably be remembered as a year of political surprises. We had the Brexit vote, we had a referendum in Italy, and we had a surprising outcome for a U.S. presidential election. The Brexit vote and the Italian referendum didn't have significant impact on the market, some sell-off and then a rally afterwards. Obviously, the presidential election created a rally in U.S. high-yield market and U.S. stock market, resulted in some higher interest rates and some problems in emerging markets. But I think more importantly, or what's being ignored, is 2016 is the year that the global economy finally gained some traction. And that traction was broad-based, both in emerging and in developed markets. There's still a lot of uncertainty, and most of that uncertainty, from our view, comes from the politics. We still don't know how the UK is going to extricate themselves from the EU. And yes, we have an incoming administration, but right now we know what the new president has promised. It's not clear to us. We know his exact priorities. And then we also have to think about what the probabilities of all these promises are. He's got things he wants to do on immigration, certainly on tax reform, a border tax, changing the way companies can tax imports versus exports. He's going through a whole area of deregulation. So there's a lot of uncertainty in there, and a lot of that takes congressional approval, and we think the market may not be fully understanding just how complicated that is. But the good news is, and one thing where there is a little less uncertainty is on the economic outlook, where we do see more broad-based growth. We think growth is going to be higher in 2017 than it was in 2016. That growth is coming from a variety of places, and we also see a normalization of inflation during the year. I think in 2017, it's going to be a year of maintaining balanced portfolios, balancing different types of risk, making sure you have some duration risk in the portfolio, making sure you have exposure to some of the growth assets, both high yield, U.S. stocks, emerging market stocks, and bonds. So that balance is going to be important. And then with each of these sectors, making sure you're very well diversified. That's going to be another critical element to the market. We think two areas that give us the most hope for investors looking to generate more income would continue to be securities backed by mortgages in the United States, both residential and commercial mortgages. We think those offer attractive opportunities. And another area, which is a little bit more controversial for a lot of investors, is we do think people can continue to shift towards emerging market assets. Many investors have asked us, why emerging market debt? The Fed's going to raise interest rates. That's a horrible environment. We would argue and ask the question, wait a second, throughout this long period of very low interest rates, emerging market countries have suffered and emerging market assets haven't done that well. And that's predominantly because the missing piece of the puzzle has been stronger global growth. So if you're a believer in a more synchronized global recovery, we think it's time to put more of your assets into the emerging markets.